In this presentation, we will enter transactions related to our open items list. When we entered the transactions from the bank statement into QuickBooks, we had some items that were open items. We've addressed a few of those. Now we're going to go through the rest of those open items and enter them into our QuickBooks system within QuickBooks Online. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in our guitar lessons and equipment file. We're going to go now to our open items list and see what we have and then make adjustments to our guitar lessons and equipment file. Here is our open items for January. The first one that we haven't addressed yet is a $10,000 amount on 127. It's going to be in uncategorized income. So we're going to go back to our file and we're going to say, let's go to our reports. We're going to go to the reports. We're going to take a look at our profit and loss report because that's where we put most of these open items into the uncategorized accounts on the profit and loss. We'll scroll up top, changing the dates from 01/01/19, 02/28/19, January through February 2019. We here have this uncategorized account for that $10,000. I'm going to select that item, and here's the information or the item we were having a question about. Now we're going to say that the owner answered that question, said, no, it's not a loan, it's going to be an owner deposit. So the owner deposit. So we're going to say it's an owner deposit. It came from the owner that put money into the business. So it came out of the personal account for the owner and went into the business account. We're going to go, okay, that's good. We're going to go on our side and make that adjustment. We're going to go into this account then, select that $10,000, and we're going to reassign it from uncategorized income. It's not income, it's not a loan. It's some type of equity account. So if we go down to equity, the owner put it in, therefore it's an owner equity. Now we could put it into owner investments. That could be a place to go, or just directly into retained earnings. If we want to track the investments, the money going in from the owner separately from other equity, we can use this owner investment account. I'll use that one. And then we're going to say save and close. Yes. And then let's scroll back up and go back to our report. It has now removed the uncategorized income. We don't have any uncategorized income anymore. Let's go up top and make the balance sheet report. That's where it went. Right-clicking on this tab up top, duplicating it. I'm going to pull the one from the left to the right and then make the balance sheet over here by going to the reports on the left. We'll then go to our favorite balance sheet report, one of the two favorites, and change the dates from 01/01/19 to 02/28/19, January through February 2019, and run that report. And then up top, we are going to have, let's go down below, we're going to have the owner's investments in the equity section. There's that $10,000, there's where it goes. Shouldn't be on the income statement because, of course, it's not income. It's going to be an owner deposit. It's going to be something that is basically owed back to the owner in essence. Okay, let's take a look at our next open item. We're going to say that one's done, so I'm going to highlight it. I'm going to cross it off and possibly make it yellow. That seems to be what we've been doing so far. And so we'll have that. And then the next one, we have an Epiphone. So Epiphone, what is it? Is it inventory? We're going to say, yeah, that one is a vendor. We're going to say it's inventory. The same will be true for Gibson. So we're going to say that these two items are inventory, guitar inventory. So now we're going to say, all right, they buy guitars and sell guitars. What am I going to do with that on a cash basis? To see that, let's go back to the profit and loss. We're going to go down to the uncategorized expenses. Here's all the uncategorized expenses. We'll select that item. And anytime we see Epiphone or Gibson, we're going to change that. I'm going to hit the hamburger up top so we can see more real estate. So we're going to change it from uncategorized to something else. Now it's inventory. Now normally when we buy the inventory, we would put it on the books as inventory, and then we would have to expense it. We had to track the inventory, expense it when we sell it. Now because we're on a cash basis here, we're just going to expense it at the point in time that we paid for it. So just be aware of that. We're going to take it directly then to cost of goods sold, and we're going to hopefully assume then that the inventory isn't outstanding for a long period of time. So again, if we're tracking inventory and we have a lot of inventory that's outstanding, this system's not the best to use. You can't really use a cash-basis system very well in that way. That's why you want mainly an accrual-based system for this cash you want no inventory, typically, a service company for this kind of system. But if we do have inventory, we can make this assumption, and it could be okay depending on the types of inventory we have. So we just want to show that. So we're going to go here, we're going to go to the Epiphone, and we're going to change it from uncategorized to cost of goods sold. So it's going to be cost of goods sold. We'll save and close that and say yes. We're going to do the same for Gibson. I'm going to go into that item, and I'm just going to change this to cost of goods sold, like so, and we'll save and close that, and we'll do that all the way down. That's going to be the same for every time we have Epiphone or Gibson. So here's another Epiphone, so I'm going to go ahead and go into that item, and we're going to say that's going to be a cost of goods sold item, so we'll say cost of goods sold, save and close. We're looking for more Epiphone and Gibson. Here's another Epiphone. We're going to select that item, and we're going to say this should be cost of goods sold, and we'll save and close that. The next item is, the next Epiphone is here. That's the one we want. So we'll select that, and we're going to say that this should be going into cost of goods sold, and we'll save that. Save and close. So now we have removed all of those. That's good. That takes this down a lot. So if we go back up top then, we'll go back to our items, and then we're going to say within cost of goods sold, we now have this item, cost of goods sold. And this again would mean that the inventory was actually sold, not just purchased. And we're putting it on the books when it was purchased or at least paid for. So if we select those items, we'll see those items here. So there they are. And then if we go back, you might say, well, what would happen if it wasn't sold yet? Well, that would mean that we got an expense here for a guitar that doesn't have any related sales yet because we don't have a deposit for it, and therefore it should be on the books as inventory, but we're not really tracking inventory because we're on a cash basis system. And that's the problem with inventory and a cash basis system. Okay, so the next item, let's go back to our open items. We're going to say that that one has been found. So Epiphone, Gibson, those are done. We're going to say that's done. Going to highlight it and cross it out. Seems like a double. We don't really need both, you would think. But anyways, we'll go to Vanguard. Vanguard, is it an investment? Is it a personal investment, or is it a business investment? A lot of times if you see something in something like Vanguard stocks and bonds or something like that, you're probably going to say, hey, unless this is a 401k account or something like that, you may not want it in your business account. It probably should belong on the personal side. But in this case, we're going to say it's going to be a business account. We want to track it on the business side. So we're going to say, all right, we're going to take this out of here. We're going to put it into an asset account, an investment account. So that's what we'll do with that one. We're going to say that's going to be down here in uncategorized in the 20,000. We're going to take that 15,000. We're going to take it out of an expense, and we're going to put it into an investment. This is going to go into stocks and bonds. So I'm going to call it investment. So it's going to be an investment account, not equity. It's going to be an asset type of account. So it'll be an investment. We're going to say that it's going to go into an other current assets. So we'll say other current assets type of account. And we're going to choose investments other. Investments other. Investments will be the name. We'll save and close. And then we'll save and close that and say, all right, now that has been removed from here. So it's off of the income statement completely and has been moved to the balance sheet. So if we go to the balance sheet then and refresh or run the report again, we'll now have an investment of the 15,000. That's stocks and bonds. They took it out of the cash checking account, put it into stocks and bonds. So it's not an expense. It's going to be another form of asset. It's going to be another kind of asset. So then we're going to go back over here and say, all right, we found that one and we've done what we're going to do with that one. So we'll cross that off and we'll make it yellow. Cross it off and make it yellow. Then we've got the Epiphone. We already did that one. So we might do this easier by just paintbrushing this and putting it down there. Then we have the hot air balloon rides. We're going to say, hey, was that business or personal? And we're going to imagine they said that's personal. That's a personal thing. Hot air balloons, it's not a business. It wasn't a business kind of activity. So we're going to say, all right, we're going to go into that and say that we need to remove that from an expense to a draw or some type of equity account. So we go to the profit and loss and we're going to look for that hot air. There it is. We'll select that item. And then anytime there's a personal item that happened, a payment made that was personal, we're just going to put it to an equity account instead of an expense account. So we're just going to say that's fine. We would rather not have personal things out of the business account, and rather you just take the draw out, let us know, and then spend it on personal items. Otherwise it could get confusing. But if it happens and we can identify it, which is usually the problem, if we identify it, then not a problem then, because we can just go in here and say, all right, it's not income, it's going to go into the equity account. And you could make another account called equity or draws. They are going to use the owner, pay, and personal. That's what we've been using. That'll work. We'll say save and close. Yes. And so it's been removed here. It's going to go not to the income statement, but to the balance sheet, not affecting net income. If I go back up top and run this report, it's going to be in the equity section. Here it is under the owner, pay, and personal. If you select that item, then you've got the hot air balloon there. So there we have it. Scrolling back up, back to the balance sheet. Next item, that one has been done. I'm going to highlight this and paintbrush it. And we've got the hot air balloon rides. Now we've got Wild Bill's Steakhouse. Same question we have, is it business or personal? We're going to say that that was personal as well. So if we're saying that that is personal and not a business expense, then we'll do the same thing to it. We'll go to the profit and loss. We'll select this item, and we're going to change it to, once again, an equity account. We'll change the drop down, we'll scroll down, and we'll put it into the owner, pay, and personal. Save and close, and that'll remove it from the income statement altogether, bringing it back over to the balance sheet. So the balance sheet, if we refresh that report, that too then will be in the owner's pay and personal there. If we select that item, then we've got the steakhouse as well. So there it is. We got the, well, here's Wild Barrel. This is the one we just did. That's the one. So if we go back, we're going to say that one is done. So we'll use the paintbrush. Now we already did Epiphone, and this one we did before, so I'm just going to highlight all of these. And that looks good for those. Now we're going to say we have a draw. This was the draw that they took out for $300. So they just withdrew money from the bank. We didn't know if it's business or personal, because it's just money that came out of the bank. We know what's the normal thing you want us to do with the draw. Now they're usually, hopefully they're going to say, well, it's personal. Whenever you see a draw, it's personal. I just took money out of the bank for my personal use. That would be the normal thing. And if that's the case, we're going to say, all right, every time we see a draw, it'll be personal. So we'll do the same thing to it. We're going to go back to our profit and loss. We're going to say there's a draw. They took money out of the checking account, just cash out of the checking account. And we're just going to change that and say, all right, that's going to be, once again, the business, the personal, the equity. So it's going to be the owner's pay and personal expense. So we'll save it there, save and close, remove it from this item, no longer on the income statement, now on the balance sheet. If we refresh the balance sheet or run that report once again and scroll down, it should be in this number. So we have it here again, and there's the amount of the draw. If we go back up top, back to our report, that's going to be everything for January. Now February should be easier because of course we've answered a lot of questions now. So if we go back to February, we have the Ted Steakhouse, 970. Now if they do say that that should be some kind of meals and entertainment, again we might want to ask the tax, if they start to ask us about it, should it be this or should it be that, we're going to say that's a tax question. If we're just doing the bookkeeping, we'll put it, if it's personal, we'll put it to draws, we'll take it off the income statement. If you think it's business related and should be there, then let us know. We recommend talking to your tax professional. Let's say this time they want that to go under business expense. So now we're going to go, all right, well, that's a business expense. We're going to go back to the profit and loss. We've got the steakhouse here. He says that one was a business expense. We talked to our tax person or whatever, and we're just going to put it where they say we should, given the fact we're acting as a bookkeeper here. So we're going to say, all right, then we need to have an expense account for it. Now, when you're thinking about the expense account for like things like this, it's often like meals and entertainment. Taxes have actually broken that out in different kind of ways. So you want to maybe differentiate travel, meals, and what type of entertainment and whatnot, because there could be different tax consequences let's see what QuickBooks gives us basically for an expense for like something like meals and entertainment. So the generic account gave us meals and entertainment, so that's where we'll put it. We'll put it into meals and entertainment, and we'll make sure to note that account and say, hey, you know, that one's probably one. If you're doing, when you're doing taxes at the end of the year, you might want to go in there and break it out to some more detail. Is it travel meals? What type of entertainment? You know, what type of business activity was happening? It might be something you want detail on. It might be something we just print this report out, the GL report, to show and help out at the end of the tax time so they can see the detail of that if they need to do anything with it. So we'll save and close that and say okay. So now that meal came out of here. If we go back to our reports up top, it went into the meals and entertainment. So here's meals and entertainment, that $970. So that looks good. We're going to go back down and say that one's done. So I'll highlight this, we'll paintbrush it, and we'll go back down. Now the Epiphone, we already figured that one out. So we already changed the Epiphone. We did that to all the Epiphones for January and February. And then we have the state tax for the vendor. So we're going to say, all right, what was the state tax? Now it could be sales tax. It might be some other tax. We're going to assume that they said it's sales tax now. So we have the state tax that we have to deal with, which they're saying is sales tax because, and that's going to be like usage tax. So now they made a payment for state tax. Where are we going to put that? So we're going to go back over to our report and we're going to say, all right, well, we're going to go into the uncategorized expenses. We'll find that item. So here it is. Here's the state tax. We're going to select that. Now it was paid for sales tax now. We haven't been tracking sales tax, of course, because normally in most of the states, the sales tax has to do with inventory items and not service items. So we haven't been tracking the sales tax, but if they are owing sales tax and they made the payment, then now we're going to enter that into an expense for sales tax. And we'll create a new account down here. We're going to create an account called sales tax. Now, if we were running full service bookkeeping, then we would be tracking the liability for sales tax when we have the invoice or sales receipt, and then we would track the tax and the liability and then make the payment within the system. On a cash basis system, of course, we're not tracking the liability because that's an accrual thing to do. And so we're just going to enter the sales tax as they happen. And that's why it's going to be more difficult for companies that are subject to sales tax, such as those that might be having inventory that might be subject to sales tax under a cash basis system. That inventory, of course, once again, makes it a little bit more difficult to use strictly a cash basis system. Works best with a service company. But you can make modifications depending on the complexity of the inventory that we have. So we're going to say it's going to be an expense type of item. We're going to go with taxes paid as the item. So taxes paid, then we'll save and close, and that'll be where it goes. We're going to say save and close and yes. So now we've moved that out. And if we go back up top to our summary, then we have the sales tax, and there it is. It's still on the books. It's still lowering net income. In other words, it's not on the balance sheet, but now it's broken out into its own category. So we'll go back to our sheet and we're going to say, all right, there's that. I'm going to underline or cross out the taxes. Now we have the IRS tax that we had here. So let's do that one more time. What happened? We're going to do this and cross that out. Now we have the IRS tax that was paid. We're going to assume here that the owner basically told us we're a sole proprietor, and these are going to be taxes we paid either for estimated payments or for the prior year taxes that we are paying. And that means if they're a sole proprietor, they're paying it on the 1040. So what we want to do then is usually take that out of the income statement and put it in as an owner payment, basically as a draw type of payment, because it's not something that we would typically record as an expense on the sole proprietor, because if we're using this information for tax preparation, the tax preparer would record the payments that would have been made in a different area. So we typically will pull out the taxes and record that as a draw. We still want to track them and give that information to the tax preparer. So for example, if this was taxes on the last year, 2018 in this case, we might want to put in the footnote, hey, this is taxes for 2018, and make sure that we provide that information in our report to the tax preparer at the end of the year. Or if it's for the first quarter of 2019, we're making quarterly payments, we might want to put that in the notes. So there's a couple different options that we could use for the tax payments here. So if we go back to our reports, we'll take a look at a couple of them. If we go to our uncategorized items and we select our taxes, so here's our taxes for the income taxes. Now one item is to just put this to the draws account. So we could go up top and we could put it to the equity and the draws, and then make sure that we report that to the tax preparer and show them, hey, the payments were made. These are the payments that were made. Another method we can use is try to use some other type of income statement account that's kind of down below the net income to break it out of the net income, so they can see, the tax preparer then can see on the income statement that there is taxes that were paid, even though they're not going to report that on like the Schedule C of the income statement, but might report it somewhere else. It might be easier to see that way. So let's use that method here. We're going to create another account called income tax. So we'll make it income tax. And again, note that when we think about the income tax for a sole proprietor, it's really income tax on both personal and business records. So we don't really want to include it in net income on our records because then it distorts our income. It distorts our calculation. But if we put it on the bottom and we put it in as other income and other expenses, then we can keep it on the income statement so that the tax preparer is sure to see it. And we can also not have it included in our operating income, still have a bottom line item. That's going to be the method we'll use here. If we don't want to do that, if we don't want it on the income statement at all, which might be more proper, but also might be something that the tax preparer could more easily miss, or something that, we'll have to take another step to track, we could put it under the draws account, and then it wouldn't be on the income statement at all. So we're going to put it on the income statement here. We're going to say income tax. We're going to say that this is going to be an income tax expense account. We're going to change it from expense to other expense, and that's going to put it at the very bottom of the income statement. And then within other expense, the detail type, we're going to use other miscellaneous expense. So that's what we'll have it. We'll say save and close, and save and close, and yes. And then if we go back to our report up top, we're going to see that now it made this other category down here. So here's the expenses, and then we've got the other expenses down here. We also have a subcategory of net operating income. So this is kind of like our net income before the unusual stuff. You can think of it in that format. And if you do that, then you can give this one report, the profit and loss, to the tax preparer if that's all we provide and the detail for it, and they'll be able to see this income tax, and it won't affect our net income here on the net operating income, so that we can make decisions on it. It doesn't distort that income, and we can record it down here so that the tax preparer still has it, but it's still on the income statement then. Otherwise, it would be on the balance sheet, and we'd have to, of course, we'd still have the data. We can pick it up, but we might have to then just run another report and be more careful to make sure that we're running that report. Also note that when we put this information in there, we might want to put a note. If I check this off and I say, if this could be something, if we have the information to say this is for 2018 taxes, right? Or we could say it's for the first quarter payment of 2019, if whatever the case may be. And it's useful to do that, to apply it to the correct, help to apply it to the correct year. And then we're going to say, all right, go back. Then we're going to cross that item off. So that one is done. So we'll paintbrush this, cross that out. And then we're going to have the draws. Now again, we said last time the draws, this is the owner taking money out of the business. The owner just took the money out of the business. We put that last time into draws as if it took it out for personal use. We hope that that would normally be the convention. But let's say this time it's not. Let's say this time the owner says, well, that's for business use. And we're going to ask, well, what was it for then? Like, what did you spend the money on? And a lot of times they don't know because, of course, it's cash. They took the money out. They don't know where it went. And if that's the case, then we have to put it to some kind of miscellaneous expense account. So again, they might ask us, well, can I do that? Should I do this or that? And we're going to say, well, it would be best to categorize it from a record-keeping standpoint, but we're not going to give you basically tax advice on it. You should ask your tax preparer for it. For the best audit trail, however, it would be best to not have cash transactions out of the business account, because we don't know who you paid, and therefore we don't know which expense account to use. So if we have a whole lot of accounts in like miscellaneous expense, then that looks really funny because it's all uncategorized. So we don't really want that. All right, in any case, we're going to go into uncategorized and select that item. And we're going to select the 300. And we're going to change it, and we're going to have to put it somewhere, which will be like miscellaneous or something like that. So we'll say miscellaneous. They don't have a miscellaneous account. That's unusual. They have an account in the general accounts called other business expenses. So that's I guess that's appropriate. Other business expenses. It's just as ambiguous as miscellaneous. So we'll use that one. That's the one that they gave us in the chart of accounts, the generic chart. So we'll say save and close. And yes. And then if we go back up top, we're going to go back to our reports. And now we have fully removed the uncategorized revenue and the uncategorized expenses. And that's when we know that we're good now. Okay, we're done. We've done the data entry, we've done the bank reconciliation to make sure we entered all the data, and we've recategorized anything that we had questions about, and we've gone through our open items and basically crossed everything out in so doing. So now we're in essence done with this 2 months worth of data entry for it, and can basically print the reports for it and provide the reports to our client or for ourselves for those 2 month time period. For more accounting information and accounting courses, visit our website at accountinginstruction.info.